Subway is already pulling back on a free sub offer. Hello and welcome to The Week in Restaurants, where we look at the most important stories of the week in the restaurant industry. I'm Jonathan Mays, Editor-in-Chief of Restaurant Business, and I am here with RB Executive Editor Lisa Jennings. Wingstop just reported its first full-year same-store sales decline in more than 2 decades. Lisa will discuss that. Nelson Peltz is at it again with Wendy's. We'll discuss all of that nonsense. Later on Tech Check, Joe Guszkowski talks about how restaurants are spending their tech dollars. We also bring you a new feature this week from our sister company, Technomic. In this case, Robert Byrne talks about one of the key challenges at the sandwich chain Subway. And speaking of Subway, Lisa, are you a member of Sub Club?
I am not a member of Sub Club, but I understand there have been some changes, or there will be some changes.
There will be changes at Subway. I don't want to delve too deeply into this because Robert has some really good stuff from Technomic, some really good Technomic data coming up later on. But they, in December, kicked off, they brought back Sub Club. Now, if you remember, us old people, Lisa, do remember the old version of Sub Club, where you would collect a card and you would collect stamps. And if you bought 8 6 inches, you would get a free 6-inch sub. I believe that's how it was. Sub 8 6 inches, and then you would get a free 6-inch sub. They brought it back in December as a loyalty program. They changed the name of the loyalty program to Sub Club, which does make sense. And this time they gave customers a free foot-long sub with the purchase of 3 foot-long subs or 6 inches. What's more is they also accumulated points for the subs they purchased because it is also a points-based promotion.
Still a good deal.
And you could get stamps on discounted subs. So the calculation, I believe, and I think we've covered this in a previous video, but the calculation is like you could, if you bought some expensive subs on a deal and then got an expensive sub with your free sub, I mean, you could get up a 50+% total discount on all of it because they still run a lot of discount deals through the app in particular. Franchisees push back immediately. And I do mean this. Like, I know a lot of Subway franchisees. I know a lot of franchisees in general, but and I had the negative comments that I heard were as intense as anything that I've covered in some time, at least when it comes to franchisees' views of things like this. I haven't. And I think the key quote is that one operator on a company chat room called it financial suicide. Well, this week, Subway told franchisees and customers, by the way, that they're pulling back on that free sub offer. On April 1st, they will no longer allow you to get a free sub if you buy 3. So they'll stop with that particular promotion. They're going to honor it. They'll honor it between then. So between now and then, if you buy 3 subs, you'll get the 4th free. And that 4th free, you have 2 months roughly to redeem it. So if you buy, and I know you're going to run out and do this, if you buy 3 foot-long subs, you can still get a free that 4th one free. But you starting next week, you will not be able to get stamps on a discounted sub either. But I want to hone in on the fact that they're essentially pulling the 3 buy 3 get 1 free offer off the table, which is essentially what it was. And they're just shifting to a traditional points-based program. Their old program was I don't know that there was another one that was as generous as that one. And I understand why they did it, why Subway as a company tried to do it. You want to get people on your app. You want people in the loyalty program. They said they got 1 million members of the in the loyalty program since that kicked off, which is significant, I think, for Subway. But it's also a real clear sign that this thing wasn't working for franchisees at all. And if you're going to do that, it has to generate some traffic And the problem that they have now is that they're walking back on this very quickly. And that is, for a company like Subway, I just don't even, I'm almost kind of speechless. I mean, it was something that franchisees in the run up to the offer had said, this is too much, this is too much, this is too much. We're not going to be able to work it. You have a brand that has closed more than a quarter of its locations. I think closer to 30% at this point, depending on my math, since 2015. You got a lot of franchisees that are just walking away from stores. And, and then that has relied so much on discounts going back for a long time. And you do this, and now you're pulling back on it.
Well, on one hand, you have to give them credit for listening to their franchisees. I mean, the franchisees made it very clear they didn't like it. They didn't like it when it was coming. They didn't like it when it was done. And now they're listening to them. So that's good. But what you're saying is that there's going to be a blowback from the consumer standpoint, because consumers, This is a pretty generous deal. Consumers are going to say, hey, you said you were going to do this. Is that what you mean?
I mean, I'm concerned about, franchisees. I mean, they obviously welcome this. They obviously do, but right. I'm concerned about the consumer reaction. With consumers, I mean, Subway needs customers without question. And again, I go back and I understand why the company keeps doing things like that, because they just need traffic. They have too many stores and they need a lot of people buying subs. And people only buy so many subs, and there's so many other things that they can get. You can get sandwiches from a lot of other different places and things like that. An individual store just doesn't make any money. You only make about $500,000 at a typical in revenue at a typical Subway. If you own just one Subway, you are working for a job, and it's not a high paying job. And then you just load up in these discounts. I mean, again, restaurants need to provide value to consumers. We all know that. And Subway is certainly one of them. There are ways to do it, but it was just such an aggressive offer. But yeah, I mean, they're listening to franchisees. That does make some sense. And they did pull it back quickly, and you do give them some credit. Like, they realize it wasn't working, and they're pulling it back. Right. But we've been watching Subway for a long time, Lisa, and this thing happens all the time. I mean, it happens I think too frequently with them, where they put out this aggressive offer after franchisees say, hey, that's too aggressive. And then they pull it back when they realize it probably was too aggressive. I'm just a little bit disconcerted about what this is going to do to the customer reaction as well. Not that they shouldn't pull it back necessarily, obviously. I just think it's important on these types of discounts, especially with a company like this, that brands really do need to be very, very thoughtful about how they go into these things. Right. And be careful. If it's going to be super aggressive, couch it as this is an introductory offer or something along those lines, I guess. But going back, I don't know, 10, 15 plus years, the number of times they've had these discount promotions and then pull them back, or, they offer a discount, franchisees complain, or they don't even accept it, and things like that just happens a lot. And what you're doing with Subway is you are damaging the relationship with the customer. So these two groups need to get in better alignment.
Right. And sadly, that means the franchisees are going to be, hurt coming and going, because, they would have been hurt by these aggressive discounts because of their profitability. Now, if consumers do pull back and feel like they've been ripped off, or that that the deal has been yanked, in front of them after being dangled, that if that hurts their traffic, then the franchisees lose. So
it's they can't, what can't happen is them losing traffic.
Right.
And they've been losing traffic. And again, they got a bunch of new people on the loyalty program. That is good. It does, in some weird sense, does operate like an introductory offer. Great. Yeah. But I will say again, franchisors and franchisees need to have some alignment. And I think in that system, more than any other system that I cover right now, there is just that alignment isn't there. Subway will tell me that it is, but there were 5 operators representing 5,000 plus stores that signed a petition calling for changes in the program, which we had reported a couple of weeks ago. There is a group of franchisees that they don't address. Subway will not talk to the independent franchise group, which probably represents somewhere in the neighborhood of 30 to 40% of the franchisees, something like that. They won't talk to them, and they need to talk to them. You got to talk to your angriest franchisees.
For sure. Yeah.
And too many companies don't do it. And then the problem is that some of these franchisees come to people like me and voice their concerns. And you also don't want that. As much as I am perfectly fine writing stories on these sorts of things.
Right.
You know, you want to get alignment with your groups, and I don't know. It pays to talk to your biggest critics in a franchise system. Anyway, by the way, Lisa, I hear there are 21-year-olds that do not know a world in which Wingstop sales have declined.
21-year-olds specifically?
Yeah.
Yes.
Well,
yeah.
People...
Wingstop didn't have a great year last year, although things ended kind of better than I think Wall Street expected anyway. But 2026 is going to be Wingstop's year, or at least that's what, CEO Michael Skipworth is arguing, because last year was the year they brought in this new, smart kitchen system. It's digital system. Any restaurant that moves from paper chits to a digital system is going to see a benefit. And now it's rolled out system-wide, at least domestically. And so, in the company units, which have had this system in for more than a year, we've really seen good results. They had positive same-store sales in the fourth quarter. The company units, there's only 55 of them. It's mostly franchised now with over 3,000 locations now. So we're going to see that benefit, I think, in 2026 for Wingstop. So that's something to look forward to. The chain also is going to be launching its loyalty program, which they tested last year and is showing some good early results. What they need at Wingstop is speed. This is the absolute focus of what will change things there. Yes, they were dealing with the tough economy. Many of their consumers are lower income, although they pointed out that they're actually attracting more higher income folks, which is a good thing in this economy. But what they need is speed, because if you try to order any kind of chicken on a third party platform, if it says it's going to be longer than 30 minutes, you're going to move on. You're not going to order that. So Wingstop, their new system brings their speed down to hopefully about 10 minutes. On average, about 50% of their units now are doing the 10-minute service time. And that's a good thing. If they can get faster, they will increase frequency. People will choose it for lunch. That's the whole goal here. And so this new smart kitchen system is enabling that, or will. It's a work in progress.
Did they mention anything? Did they mention anything about Hispanic consumers? No,
didn't come up, and they didn't say anything about lower income either. They just said that it was a challenging macroeconomic climate, which is why they ended up, for the year they were down 3.3% and 5.8% for the fourth quarter. So, they and the beginning of this year has been choppy, they said. So we'll see more of that. But they are saying that they're bringing in more customers, and that they have all these things to look forward to for 2026 that will change the game. Game changing. Yeah. That's what Michael Skipworth keeps saying. It's game changing.
Okay. I'm in favor of operations, and speed are usually a pretty good combination. Yeah. And tend to be underrated. And all companies have, you're going to have some years in which things aren't going quite as well. Last year was a tough overall economy. And it's also worth pointing out that the previous 2 years, I think they were doing 40% plus comps on a 2-year basis. Nobody can expect comping positive on top of that.
Right.
Maybe, but it was just so off the charts. But at the same time, at the same time, like when we have, like Popeye's going through the same issue. Both Wingstop and Popeye's. It's interesting that both of those chicken chains had challenges last year. And both of these companies are drawing a clear line between their operations and their results. And both of those companies have evolved beyond what was their original core product. Popeyes being bone-in chicken, and then they do sandwiches and tenders and all these other things. And then Wingstop had done chicken wings for a long time, and now they're doing chicken sandwiches. I might wait a little longer for chicken wings because I'm probably planning that visit a little bit more, and it's probably for dinner or some other special event, whereas chicken sandwiches are for lunch, and I don't have much time for that. So I understand that. So, I mean, it's kind of interesting from that particular standpoint, but I think that, sure. But, you have a choppy first part of the year. I do believe that there are some of their customers that are really challenged. The low-income consumer, I think the Hispanic consumer does tend to use Wingstop quite a bit. And I really, 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 really wish more companies would talk about that. I think that is an absolute underrated impact on sales last year. And not to get on a soapbox, Lisa, but to get on a soapbox. The restaurant industry is saturated. It is saturated. There are more than enough restaurants in the United States. The U.S. population is roughly growing at a 0.5% rate per year. And it's not from people that choose and eat meals. That growth is coming from babies because we're not bringing people in anymore because of immigration issues. And so it is very vulnerable to challenges with certain types of consumers. And you have a large number of Hispanic consumers that are not eating out as much as they did before because they are concerned about ICE and immigration and things like that and stuff like that. And I think it's sort of a depressed consumer that is not eating out as much, and I think that is a little disconcerting. It was a lot disconcerting from a restaurant sales standpoint. Jack in the Box earning talked about that as well, and they've had some issues. So that's my little soapbox, Lisa.
Yep. You're absolutely right. I totally agree with you. And it's interesting that Wingstop is talking about bringing in the higher income consumer. I mean, this is something that we're going to continue to see this year. It's just not going away. And I think, Wingstop will have easier comparisons, in 2026 to be able to show some results. But I think that, fundamentally, we're going to be hearing people talking more about what they're going to do about it. I mean, it's one thing to keep kind of going on and on about how the economy is terrible and challenging and, people are not dining out as much, but what they do about it is what we're going to see. We'll see the ones who know how to face a challenge. The resilient brands will really, be the ones that rise up, and we'll see a lot of folks struggling. So
yeah, we'll see. But they'll have to show some sales growth this year. I mean, that's you can have a bad year. If you have 2 bad years, then your people are going to start asking questions,
right?
And Wingstop should understandably get a pass from last year because their previous 2 years were just so off the charts. But now you've got to start. You're telling the street that, hey, this is a service issue or a speed issue, and we're fixing it. And so they're going to need to show some sales growth this year, which hopefully they do.
Right. And speaking of brands that need to show sales growth, Jonathan, let's talk about Wendy's. Will Nelson Peltz do it or won't he? He might not. What's he
needs to get out?
Is he?
I mean, like if he's going to buy it, buy it.
Mm-hmm.
If he is going to buy Wendy's, buy Wendy's. Just buy it, preferably with somebody, in partnership with somebody that knows the restaurant industry or something along those lines. But stop messing around.
Yeah.
I mean, I don't think Wendy's has gone through a lot. And I have said this before. Wendy's is a really good brand with a really good quality positioning, and has historically had some really good people working at that company. And we could talk about challenges, issues with breakfast. We can talk about, some of the marketing last year, and that sort of thing. But think about what they've gone through since 2022. And it was in 2022 when Nelson Peltz said at the time, you might recall, that he basically had a very similar filing to this one, saying he was considering his options for his investment. He's a big investor in Wendy's, 16% still. He's considering his options for the investment, and that could include any number of things, including a potential purchase. And instead, he ended up the next year, the company instead did a reorganization by effectively eliminating some middle management positions. So they got rid of the head of the U.S. market and made Todd Penegor, who was a CEO at the time, oversee the U.S. market. And and then they increased the size of the dividend. By 2024, then they pushed out Todd Penegor and then hired Kirk Tanner from Pepsi. So that's one CEO change after a long time. Any CEO change is always a risk because you bring somebody else in with a different leadership style, different culture. They hire their own people, and it results in a lot of changes. That it happens as a fact of life, right? And that's why you probably want to do it less often than companies really shouldn't just change CEOs at the drop of a hat. You got to give your people time to adjust to this. And if you're going to change CEOs, you got to make sure that the guy is going to be the right one for the job and spend some time there. Within a year and a half, Kirk Tanner was gone. And by the way, in the middle of this, then he essentially goes off on he mentions dynamic pricing on an earnings call, and that led to it was kind of media nonsense a little bit, but whatever. And then 18 months later, he's gone because he wants to go back to the CPG industry that he was more familiar with.
Right.
And now the company doesn't have a permanent CEO. They closed locations in 2024. They are closing locations somewhere 300 to 350 locations now. You have, their same store sales were down 11.3% in the fourth quarter. They have, if they've done negative 11.3%, it was, I don't know, probably in the 90s, maybe. I don't know. I don't have any records of them doing anything anywhere near as bad, not even during the pandemic.
But what is up with them? Why are they struggling? Why is Wendy struggling in particular?
Well, that's a really good question. But look, you have all of this, like absent all of their explanations, and they give a lot of explanations, many of which are very plausible and reasonable and probably correct. They kind of lost the Wendy's way, for instance. That's one of the things that Ken Cook, who was the interim CEO, who, by the way, did not really have any restaurant experience, at least as an executive, before he came to Wendy's in 24. And then he was thrust into this position. So you got somebody who isn't that familiar with the restaurant business, following somebody who came in brand new into the restaurant business. So whatever. So there was that. They had they front-weighted marketing in 25, and then didn't have any more money left or something like that towards the end of the year to market. And you need to have your voice out there all the time, and if you don't, it's going to create some problems. They had a chicken sandwich launch that they were planning in the fourth quarter, and apparently they delayed it for this year. I think that there's some other issues probably out there. That's what their explanation is. But think about this. You think about all of the things that this company has been through over the past few years. You have a reorganization, again, which is tough as it is. Then you have a new CEO. That new CEO lasts only 18 months. And then now you have a leadership vacuum. Of course they're having challenges. That's, of course. The breakfast issue, their breakfast is probably very weak right now, which is one of their biggest challenges. Breakfast as a day part is a little bit more challenged than the other ones, because that might be actually an Ozempic GLP-1 thing, Lisa.
Oh, interesting.
The higher end people don't eat breakfast as much.
Yeah.
Or they don't go out for breakfast, at least. That was that might be one of the impacts. But breakfast is relatively weak. So now they're going to allow some franchisees to pull back on breakfast, which is a decision you can make. It's a decision you can make, and I guess I can understand it. But breakfast is just really hard. I don't know. They've got a number of different challenges over there.
Yeah.
And Nelson, if he's going to buy it, but don't add more uncertainty.
Yeah.
That would be. I think that they need to make a decision on what they're going to do, and get somebody in there who is a permanent CEO and then can fix the brand. It is too good of a brand to let this happen to. Way too good.
Yeah,
That's
for
my
sure. I mean, it really would be a shame because it really is, Wendy's is, it's one of the top burger brands that has always been, and just to see it struggle. I mean, of course, it's being impacted by the economy, as we've just been saying. The value war thing, it's very difficult to find. I mean, McDonald's did it with Grinch socks and, and the value deal meal deal. Is that what they call it? Value meal deal?
The extra value meal, Lisa.
Extra value meal. Yeah.
Yeah.
Yeah. Yeah. So, I
So-
mean, that's tough to compete against.
Right. One last thought before we go, though, on that is that, by the way, they are, I think, depending on what Burger King does this year, assuming that Burger King doesn't close any more restaurants, which I don't really think they are, maybe a modest number, but as long as they roughly hold serve on unit count and their same store sales grow somewhere in the neighborhood of 3% this year, which is more than plausible, there is a really good chance that they leapfrog Wendy's to be the second largest burger chain, which is actually something. It's psychological, doesn't really matter. They both, are like not even a quarter of the size of McDonald's at this point. But that would be a psychological thing to me. So,
Yeah.
I mean, and given Burger King's recent issues, I just can't believe we're at this point with Wendy's. It's stunning to me. It's very shocking. Anyway. Okay, coming up later in Tech Check, we have Joe Guszkowski will talk about what restaurants are spending on technology. I think that's right. I think that's what he's talking about. But also we have a new segment featuring Technomic. We will have Robert Byrne from Technomic, who will talk about some really interesting consumer data on Subway and some and some reasons why they are having challenges. But first, whatever ad Spoon serves up next. Restaurant operators, are you ready to lead the future of food service? Join us at the Restaurant Leadership Conference happening April 19th through 22nd, 2026 in beautiful Phoenix, Arizona. At RLC, you'll connect with the top industry leaders, gain insights from iconic speakers, and discover the strategies and tools to take your business to the next level. This year, we're celebrating 25 years of innovation and leadership, making it our biggest and best event yet. Don't just keep up with the future, lead it at RLC 2026. Learn more and register now via the link in the description.
Hello and welcome to Tech Check, where I, Joe Guszkowski, talk really fast about one big topic in restaurant tech. This week, where do restaurants plan to put their tech dollars this year? According to an annual survey by the National Restaurant Association, 6 in 10 operators want to invest in tech that will improve the customer experience in 2026. That might include things like kiosks or handheld server tablets, or perhaps loyalty programs and digital marketing. This isn't a big surprise. Restaurants are doing whatever they can to please customers at a time of weak spending and traffic. Many believe tech can help. But is more tech really what customers want? Also included in the survey was this nugget. Only 41% of consumers say technology improves hospitality, while 38% believe it has a negative impact, and 21% say it has no impact. Now, there are some generational differences that probably won't surprise you. Gen Zers and millennials are far more open to using tech. But overall, most customers are not coming to your restaurant because of its technology. Operators should keep that in mind as they think about where tech fits into their operations going forward.
All right, Robert Byrne, what can Technomic tell us about the consumer view of Subway right now?
Well, the consumer view of Subway has changed over time. And as consumers tell us through our Technomic data, the issues are really less about what the brand did as much as they are about maybe what the brand didn't do. So starting off thinking about who it is that represents that Subway core guest, they've lost those younger guests, those 18 to 24-year-olds, those 25 to 34-year-olds that really were once the core of what was such an affordable brand over the years. And in fact, they still maintain some pole position when it comes to healthy options, when it comes to that ability to customize their order. You got to remember, these were pioneers of customization in a way, and they just don't get very much credit for that. But over time, what we've seen that's happened is those hallmarks of the brand, the food quality, even the affordability, the value component, consumers are less enthusiastic about those at Subway in the current period here compared to 5 years ago, 10 years ago, when they really were as I said, had pole position in those areas. So one of the things that we note in particular when we think about Subway is this idea of affordability. And they really have dropped in those overall rankings for affordability, for food quality, because, again, we've got the rise of the fast casual competitors. That competitive space has changed. The landscape's changed. Now next door they have fast casual sandwich brands and other brands and chicken brands opening up, where before, with their saturation, they really were, in many areas, the only game in town. Not so much anymore. So keeping up with that competition is really something that I don't think they did do. And one key area that I think they may have missed over time, according to what consumers are telling us, is beverages. There are a lot of these brands out there that are not just the beverage-specific brands, but others that have really diversified their beverage portfolio for their guests. And, Subway has done a lot with their menu in recent years and continues to build some attractive limited-time offers and new sandwich platforms and kept abreast. But there's some other areas that I think they may have missed. One of the key things that we've noticed this past week is some of the loyalty program questions that folks have had, particularly as they sort of try to work this out with their very deep and broad franchisee community. And that is something, that loyalty program rewards, the points, that is so important to consumers. That is one of the fastest growing measures that consumers tell us is very important when they're choosing a restaurant for a location. So getting that right is going to be really important for Subway. And I can see they're really, they're working on that. That's a big job to wrestle with. So what I'll end with here is that, we've got a lot more to offer, but if this is your jam, if you're interested in information and insights like this, you should check out our Ignite platform. You can learn more at technomic.com/ignite.
And that should do it for The Week in Restaurants, which was edited, as always, by Spoons. You can find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com. But please subscribe on Apple Podcasts or Spotify and follow us on YouTube. For Lisa Jennings, I'm Jonathan Mays. Thank you for listening.